the South African Reserve Bank has kept interest rates unchanged. This comes in line with market expectations. Governor Lesetja Kganyago says inflation is expected to stabilize at the MPC's 4.5% objective in the second quarter of next year. Ndaleng Lechela caught up with Annabel Bishop, a chief economist at Investec, Johann, chief economist at Old Mutual, and Thabani Ndwandwe, chief risk officer at Standard Bank, to discuss this decision in greater detail. Here's that conversation.
Actually, this is not a surprise. We did expect that the interest rate will be kept unchanged. If you just look at some of the data points, we're still above the 4.5%. That's the mid-range that the Sarb is, pushing for. We think we'll get there at Q4. But again, the main thing here is that we are deep in the middle of elections, so much uncertainty at this point. It would have been very difficult for the Reserve Bank to actually reduce interest rate. And that's really something that it's still difficult for consumers, but I think it is to be expected.
Let's talk about those difficulties that consumers are facing now. We are dealing with elevated interest rates. Consumers are dealing with high debt as well. Just paint a picture of the health of the South African consumer for us.
Absolutely. And one of the big things that we've seen, and I've repeated the statistics quite a bit, but we've seen consumers starting to default in mortgages. We saw that coming through quite a bit last year. One of the stats I've pushed out in there is that we've seen almost 100 billion rands worth of consumers sitting in some non-performing state, which is quite high. It's about 8.7% of the home loans population. That's really quite high. But that's just because the home loans, if you had a home loans in 2011, that home loan would be up now by 42% from 2021, apologies, 2021. So that's quite a high number. If you look at your car, your installment is up about 15%. That's quite high for many consumers, and we are sitting at a very difficult environment. And then on top of that, you add the issues of things like load shedding, inflation, and the cost of food. That has been quite strenuous on the consumers, and we're starting to see that pressure coming through. And you'll see it in many banks that have pushed out their results recently that the pressure is on.
It's definitely playing out with, that cost of living crisis really hitting consumers. I want to talk about that inflation. Now, the Sarb has somewhat improved its expectations, Annabel. Now, initially, Governor Lesetja Kganyago expected us to hit that midpoint by the end of 2025. He's revised that upwards, expecting us to hit that target by the second quarter of 2025. What have you made of that move?
So I think, he does qualify it, and he says that inflation expectations, however, are very high. They're elevated, and he's looking at the BER survey, which looks at analysts and business people, across the population generally. So I think, there is that qualifier, that concern. But of course, inflation can be quite volatile. It can move around. We've seen food price inflation come off more than was expected, and of course inflation itself. Early this year, the governor mentions that as well. We continue to expect that South Africa will see 4.5% CPI inflation reached by November this year. So we're on the optimistic side. We think it's going to come earlier than the governor does. But of course, they do provide caution. He's providing a bit of a hawkish tone. He's being careful. Possibly, there could be some other factors which could derail the inflation outcome. There's always that risk. So, we think that it doesn't really mean that they're going to rush to cut interest rates. We're probably still going to see interest rates unchanged for most of this year.
Let's talk about those risks, Johann. Governor mentioned, the weather patterns and how El Nino could be factored into inflation moving forward. Just paint a picture for us on those kind of risks.
Yes, absolutely. Food prices are inherently very difficult to forecast, given that it depends on floods and droughts, etc. We do seem to think that El Nino is a little bit weaker than what we initially expected a few months ago, but there's still that risk. We've seen maize future prices moving up significantly, but on the other hand, wheat prices haven't. They've actually eased off since late last year. So the uncertainty around that is what keeps a central bank awake at night. So apart from food, there's also the oil price risk. We see ongoing conflict in the Middle East. So despite the oil price having come down recently, there's the risk of a blow up in the Middle East that would cause significantly higher energy prices. But if things continue roughly as they are now, with no undue shocks, then with a slightly better rand down the line, I do think that some of these risks should dissipate over the next few months. So I do expect core inflation also to come down, and I think headline inflation can hit 4.5% in the second half of this year. So I agree with that view. Despite all the risks, I think things are moving in the right direction. I actually think we're getting closer and closer to a rate cut. In my opinion, the next meeting should present us with a rate cut, given the underlying inflation numbers that have improved significantly. Yes, they're worried about inflation expectations, but that's a lagging indicator. As we see actual inflation come down, then inflation expectations will also ease. The one unknown here is because our inflation weights in the CPI is fixed for a number of years, the underlying inflation is probably lower than what the headline numbers suggest, because we cannot pick up the relative price changes impact on consumer spending behavior. In other words, you and I have got a fixed monthly budget, we spend more on petrol, and we have less to spend elsewhere. That reduces price pressures elsewhere. And that's perhaps some of the reason behind the significant dip in consumer goods inflation numbers. As I mentioned earlier, that has come down to 3.5% for the weighted price index for clothing, footwear, furniture, appliances, and vehicles. So we spend less on those because we have to spend more on petrol. So those relative price changes actually means that underlying inflation is probably a touch lower than what the printed measure shows us. So I think if the Reserve Bank looks through some of these trends, as I believe they should, then we're heading closer to a rate cut.
So that cautious tone is still there, but he did then say that, you know, risks to inflation are balanced. Thabani, does this strike you as more of a dovish tone from the governor?
No, I mean, you know, the governor is quite a disciplined governor, and he will always, of course, share a strong view and send a good message. But there are real risks out there. The first one, of course, as he pointed out, is that there's in elections across the globe. It's not just in South Africa. So we have to think about that, and we can't ignore that. But in South Africa, you have to wait for the outcomes of these elections to see policy certainty. Where does the policy go? And so he's right. I think those are some of the things you have to worry about. And lastly, even though the European Central Bank has sort of hinted at reducing interest rates, if they don't, and for whatever reason they change direction, that could also pose another risk. So I do think that his tone is right, but I also agree with my colleagues here. We think that half two of 2024, we should start seeing inflation back to the range, and we should start seeing some interest rate cutting. And we all differ on the next meeting versus September. I'm sort of hinting on September.
All right, now let's talk about growth. With election risks at play, the health of our SOEs has also somewhat improved. I mean, we haven't had load shedding for over 60 consecutive days, and we've started to see that Transnet turnaround plan kind of in effect. Annabel, what's your sentiment around the health of our SOEs and how that can impact growth moving forward?
Well, you know, I believe that we're actually starting to see some substantial fruits being born from the business-government collaboration, which is coming through in the fact that we're having less unplanned outages. So, you know, the lack of load shedding is not actually a pre-election ploy, but rather one where we've actually seen the fact that there's been a significant improvement in production from electricity due to improved maintenance. And of course, Eskom does lay this out in an article on their website. But of course, as well, you know, we know that we're moving into winter, so demand for electricity will rise. Eskom again has given us an expectation. They expect perhaps an average of stage 2 load shedding. So this is a big improvement on where we were a year ago. It also shows as well that there's been some fruit born from the improvement in the congestion at the ports, so there's less congestion there, the rails as well. Overall, the business-government collaboration has been positive. Now, of course, we have seen in the first quarter, as you sometimes often do in a first quarter of an economy where you're in a high interest rate environment and the consumer is constrained, that we have seen some poor economic indicators come through, showing growth a little bit weaker than expected. The consensus and, you know, my forecast as well for the first quarter is around 0.3% quarter on quarter. So, of course, you know, that's seasonally adjusted as well. well. It takes out the December effect, but let's not forget consumers probably spent a bit more over December for the festive season. So, they are in that constraint. The second quarter, however, showing data that is actually probably going to be an improvement on the first quarter. So overall, we see that, things are improving in the economy. Obviously, there are the demand conditions as well as the supply side that you mentioned, but we do expect to see the state-owned entities continue to go from strength to strength. If government shows policy continuity and stability after the elections, we continue to see the reforms that are in place remain, then we do expect to see growth improve this year compared to last year. We're looking at around 1%, but of course in the following years, faster economic growth than that as well.
Johann, let's get your growth expectations. I mean, even with all the good things that are happening, all the reform that we're seeing taking place within the SOEs, the Sarb has somewhat kept their expectations, their outlook for growth for this year, next year, the same. What's your take on that, and where is Old Mutual pegging growth moving forward?
Firstly, in the very short term, I agree with the Reserve Bank that the first quarter will likely be weak. In fact, my forecast for first quarter growth is negative. But there's been a seasonal impact with the Easter weekend shifting from last year being fully in April to starting in March this year. So therefore, we saw a lot of very weak data in March, but similar to car sales that rebounded quite strongly because of that seasonal Easter impact. Other data will also rebound in April. So I also expect a better second quarter, and ongoing easing in load shedding, significant more private sector supply, easing in inflation into the second half, and as we've been talking about, perhaps some lower interest rates, perhaps even a stronger rand, so perhaps some improvement in confidence. My growth forecast for this year is 1.4%, so it's on the higher end of consensus. It's not a particularly strong forecast for what we need in South Africa, but at least it's significantly up from last year's 0.6%. Next year we can drift towards 2%, and this is all on the basis of more electricity supply available, less logistical constraints, and of course an improving confidence level. And as we head into next year, continued low inflation and ongoing job growth. That has been a touch of a positive surprise since the start of 2022 and the end of March this year, 2.2 million new jobs created.
That was Annabel Bishop, Chief Economist at Investec, Johann, Chief Economist at Old Mutual, and Thabani Ndwandwe, Chief Risk Officer at Standard Bank.